In our first section, risk and return concepts and principles, we will have a look at and explore the fundamentals of how risk is calculated and the methodologies that are utilized to minimize risk in a portfolio. When we analyze projects, we need to understand what the net effect of those projects are on a firm's net income. We will look through the paradigm of public companies, but please remember all the principles that we learn in this section are applicable to any size business. It's not limited just to public companies. One of the most important areas that we start by looking at is risk and uncertainty. And risk and uncertainty, obviously in any situation of risk, there's an element of uncertainty. If there was no uncertainty, we obviously wouldn't have any risk involved in the decisions. One of the areas that we study in risk and risk management is risk preferences. In other words, what is an investor's taste for risk or his preference for risk? And also what return is he going to reap from the investment? Now, one might ask the question, why would an investor accept risk? And obviously, it's linked to return. And to put it fundamentally, the higher the risk, the higher the return an investor will expect. When we talk about the term uncertainty, what we mean is that an investor is uncertain about the outcomes of that investment. In any situation, there's always a number of possible outcomes. And as the uncertainty grows about those outcomes, therefore the risk increases. From an investor perspective, there are two situations. There's certain outcomes and uncertain outcomes. Let's illustrate that with an example. If you decide to invest in one of the major banks and you're offered a return of 6%, that return is pretty certain. Say, for example, a 1-year fixed deposit at 6%. That return is pretty certain. We know in a year's time there's a very low probability or chance that we'll not get our money back. If you invest in a project which is a very high risk project, then there's not so much certainty about your outcomes. In that case, you're uncertain of what the outcome will be. Examples of those projects are high-tech projects, particularly pioneer projects. In other words, projects which haven't been attempted before. You will find that there's a high degree of uncertainty about return. Therefore, in those cases, the investor will demand a higher return to cover his risks. Before we carry on, let's just define the term return. Return can be defined as the total gain or the total loss that accrues to an investor due to his investment. There are different returns for different investments. For example, investing in shares on the stock exchange brings back two forms of return. There's a capital return. In other words, if you buy the share at 20 Rand and the share increases to 25 Rand, you would have a 5 Rand capital return. Or alternatively, there's also dividends. Dividends is an amount that is paid out each year by the company in which you invest, and it's paid out in the form of dividends per share. In our valuation section, we will explore how do you value shares, preference shares, ordinary shares, and we will look at different forms of that investment.